Welcome to This Explainer. Today, we're putting on our investigative journalist hats to follow the money, and let me tell you, we are cracking open a case file that is anything but ordinary. We're going to neutrally unpack the explosive, suspenseful claims found in G. Edward Griffin's historical deep dive, The Creature from Jekyll Island. The source material actually presents this as a gripping detective story, uncovering what it describes as a massive historical financial crime. Our goal today is to impartially report on the arguments laid out in this fascinating book and examine the clues it provides about the origins of our modern monetary system. Let's dig right in.
So the text hooks us immediately with a really profound and, frankly, unsettling question. What if the Federal Reserve System, the central bank of the United States, was never actually meant to stabilize the economy or protect the public? What if instead it was conceived in absolute secrecy by a group of private bankers specifically to operate as a financial cartel? Griffin posits that by controlling the money supply, this institution basically manages to shift its inevitable losses onto taxpayers while keeping all the immense profits for itself.
The book frames the creation of the U.S. central bank not as some noble act of public service, but literally as the scene of a meticulously planned historical financial crime. According to the investigation outlined here, the Federal Reserve is not truly federal, and it actually has no real reserves. Instead, the text describes it as a legal monopoly over the nation's money, engineered from day one to prevent banking competition and artificially expand the money supply.
All right, let's examine our prime suspects. According to the source, back in November of 1910, 7 incredibly powerful figures sneaked off to a private elite hunting resort on Jekyll Island, Georgia. We're talking about key financial architects, heavy hitters like Senator Nelson Aldrich, Paul Warburg, and Frank Vanderlip. Get this, together, these 7 men represented an estimated 1/4 of the total wealth of the entire world at the time. The book details how they traveled under false names and in a private railcar just to ensure absolute secrecy. Why go to all that trouble? Well, the author argues that if the American public knew rival Wall Street bankers were secretly writing the nation's new banking laws, the legislation would have been absolutely dead on arrival.
Now, if this sounds like a script from Hollywood's spy thriller, the author actually points to an astonishing admission from Frank Vanderlip, an actual attendee of that Jekyll Island meeting. Years later, Vanderlip wrote in the Saturday Evening Post that he was as secretive, indeed as furtive, as any conspirator. He openly admitted that this clandestine expedition was the actual conception of the Federal Reserve. The book leverages this incredible confession to establish the undeniable secrecy and conspiratorial nature of the gathering where this banking cartel was allegedly born.
Let's trace the timeline of this alleged crime as presented by our source. It doesn't start in the 1900s. The text traces the roots of deceptive banking all the way back to 14th century European goldsmiths. It then moves through the disastrous paper money experiments of the Massachusetts colony in 1690, goes directly into that secret 1910 Jekyll Island meeting, and culminates in the 1913 passage of the Federal Reserve Act. Griffin argues that 1913 wasn't a new beginning at all, but rather the perfection of an ancient financial sleight of hand.
To understand the weapon used by this alleged cartel, the investigation contrasts 2 very different types of money. On one side, you have real assets. Think of this as receipt money backed 100% by limited, physical gold or silver actually sitting in a vault. On the other side, you have fiat money. Fiat money has 0% backing. It's essentially unbacked paper conjured by government decree with a completely unlimited supply. The source vehemently argues that this unlimited fiat money is the ultimate enabler of hidden taxation and out-of-control debt.
Okay, so the absolute crucial point of the book's thesis rests on the concept of fractional reserve banking, and the author uses a brilliant everyday analogy to explain this. Imagine an ancient goldsmith who stores people's gold coins and gives them paper receipts in return. Eventually, the goldsmith realizes that his customers rarely come to claim all their gold at exactly the same time. So what does he do? He starts printing and lending out fake paper receipts for gold that simply isn't in his vault, and he collects interest on these completely fabricated loans. When you issue more paper receipts than you have gold, you are quite literally creating money out of nothing. The book contends that this exact practice is the inherently fraudulent foundation of our entire modern banking system.
This deceptive foundation brings us to a concept the author calls the Mandrake Mechanism. He names it after Mandrake the Magician, an old comic strip character whose specialty was creating things out of thin air. In the modern financial world, the Mandrake Mechanism is the specific process by which the Federal Reserve converts debt into spendable money. The book emphasizes a really shocking claim here. Money isn't created first and then borrowed. No, it is the act of borrowing itself that causes the money to spring into existence.
Let's break down how this builds step by step into a massive hidden money-making engine. First, the government needs money it doesn't have, so it prints pieces of paper called treasury bonds, which are essentially just IOUs. Second, the Federal Reserve buys these bonds by writing a check to the government. But here is the massive catch. There is zero money in the Fed's account to actually back that check. It literally creates fiat dollars on the spot. Third, the government deposits this newly created money into commercial banks, which magically reclassify it as bank reserves. Finally, through fractional reserve banking, the banks use those reserves to loan out up to 9 times that amount as new checkbook money to the public. According to the text, the cartel enriches itself by collecting perpetual interest on money that was created out of absolute thin air.
The investigation then uncovers what it calls the bailout game. Think about it. Because banks are lending out money they don't actually have, they are technically in a constant state of insolvency. So when these risky fractional reserve bets fail and a bank goes under, who pays? According to the book, the system is perfectly designed so that the bankers privatize their profits during the boom, but socialize their losses during the bust. Through inflation and government institutions like the FDIC, it's the taxpayer who is inevitably forced to foot the bill. And yes, that means you and me.
Acting as the prosecutor in this historical trial, the author rapidly lays out 7 formal charges to abolish the Federal Reserve. First, it's completely incapable of its stated objective of stabilizing the economy. Second, it's a cartel actively working against the public interest. Third, it represents supreme usury, charging interest on nothing. Fourth, it causes inflation, which Griffin calls the most unfair hidden tax of all. Fifth, because it can print infinite money, it secretly funds and encourages prolonged global wars. Sixth, tinkering with the money supply creates devastating boom and bust cycles. And seventh, it ultimately serves as an instrument of totalitarianism by allowing the government totally unlimited financial reach.
To bolster this really intense case, the book pulls in some prominent historical witnesses, heavily citing America's founding fathers. Thomas Jefferson explicitly warned that a private central bank's issuing the public currency is a greater menace to the liberties of the people than a standing army. The author leans heavily on this quote to show that the grave dangers of fiat money were well understood centuries before the Jekyll Island meeting ever took place.
Looking toward future global economic scenarios shaped by these monetary policies, the text forecasts 2 starkly different paths. The pessimistic scenario warns of a devastating dark future of banking collapse, hyperinflation, and a totalitarian society where the government steps in to control everything in response to the chaos. However, the source also outlines a lighter, realistic escape route. This solution involves taking away the magic checkbook entirely, abolishing the Federal Reserve, repealing legal tender laws, and returning to a free market banking system where currency is backed 100% by physical gold and silver.
Finally, let's test your investigative knowledge with this incredible paradox presented right in the text. Think about this carefully. Because every single dollar in our current system is created out of debt via the Mandrake Mechanism, what would actually happen if every government, business, and citizen suddenly paid off everything they owed? The shocking answer the book provides is that the entire money supply would simply vanish. Our economy would literally have zero currency. It's a system that absolutely requires humanity to remain in perpetual debt just to function. And that, the author suggests, is the true nature of the creature they created on Jekyll Island. Thank you for joining me on this explainer. It certainly leaves us with some profound questions to investigate further, doesn't it?